If you're not building, you just don't understand what's going on. We didn't realize that we were on the cusp of this like Cambrian explosion that is AI and that everything was going to change. We literally have full-time PhD AI researchers on our team because we have a venture studio. I'm just proud of the ability to sort of like march to the beat of my own drums, even if it's not like the vanilla way to do things.
What's up, everyone? Welcome to another episode of Demo Day, the podcast for entrepreneurs and venture capitalists where we demystify the culture of joining one of the top accelerators, incubators, or VC funds from around the world. On today's episode, we'll be interviewing Adam Struck from Struck Capital. Without further ado, let's get into Demo Day. Adam, welcome back to another episode of Demo Day.
Thanks for having me.
Now, Adam, last time we talked, it was 2021, and a lot has changed in a post-COVID world. One of the biggest changes for Struck Capital is that Struck launched your studio, and I thought it would be just a great opportunity to kind of let the listeners know like what was going into your thinking, transitioning from solely being a venture fund to offering a studio. And I thought it would be just a cool way to learn a little bit more about like why you even started to do that.
Totally, yeah. So it's called Struck Studio. The way we really define it is a company creation vehicle because we are literally building companies from scratch. So we do all the ideation, all the validation, all the product development, build a fully unit tested enterprise grade product, and then take it to market. The main reason that we actually started doing it was because of sort of the COVID zero interest rate, sort of era where we found that we would, underwrite deals, maybe price it like a 14 post. And then the founder would come back to us because the market was so frothy and say, hey, I got some VC to do it at a 40 post. And I remember just sort of turning to my team and saying, we really have two choices here. We need to either figure out our own proprietary access to deal flow and sort of be masters of our own domain, or we can completely destroy our sort of portfolio construction theory and, do deals at valuations that we didn't think made sense. So the answer that we all came up with is, listen, the team is full of operators, entrepreneurs. We have robust information asymmetries. We have the ability to identify greenfield opportunities and create companies. So why don't we actually do that, right? That puts us in a place that we are not sort of subject to the polarization of the macro and sort of post-money valuations that we don't think make sense. I think little did we know that we were then sort of on the cusp of this incredible Cambrian explosion of AI. And when I look back now, the fact that we were able to hire a team of builders and actually build companies, I think it sort of has created this 1 + 1 = 5 situation where we are also better investors. Because in my opinion, if you really want to understand these emerging technologies, you kind of got to be elbow deep, on a daily basis. But yeah, the reason why we started it was almost a forcing function, just feeling that, it was very hard for us to win deals within the sort of underwriting paradigm that we had set. So we said, hey, like instead of sort of abandoning that discipline, let's actually start building our own companies because then we can guarantee that we have investable opportunities.
That's awesome. And, for those listeners that didn't see your first episode, many people probably know you from Struck Capital, but they don't necessarily know that you've already started, launched, grown, sold a business. And so you come with that operational expertise. Now, when it comes to just the venture community in general, I asked you a similar question on our last podcast, but I'm curious if it has changed over these last 5+ years since we've last talked. I asked about the why, because when you have the opportunity to start and be a founder of a business, to lead and run a venture capital studio, these are 8, 10, 12 year long ventures. And I was just curious, like, why have you chosen to continue supporting founders, investing in startups, starting your own businesses? What is it about the tech ecosystem that you love so much?
Yeah. I mean, what I'm finding, like I have 2 daughters, age 7 and 3, and what I'm finding is, AI right now is sort of proliferating itself into our daily lives and sort of every aspect, right? And I kind of feel like I'm really on the front lines of that innovation, and that sort of makes me a better parent. It makes me like potentially a better spouse. You're gonna have to ask my wife that one. But I just feel like being on the cutting edge of core technology innovation is just an incredible place to be. I enjoy sort of the grind. I enjoy building. And I think investing is a lot of fun. You get to sort of work with incredible founders that can benefit from your horizontal lens. But I think for a lot of VCs, a lot of operators turned VCs, there's always a desire to be like, hey, do I still have it? Can I get back in there and do it myself? We kind of feel like we have the best of both worlds by having the company creation vehicle or venture studio and the venture fund.
When you analyze yourself, and I know it's not often that you say to yourself, I wonder what my superpower is, but I'm curious, like when so much of being a VC is pattern recognition and some of it's in that self-reflection. When you think about yourself, what do you believe that you notice that others in the industry don't notice? Or maybe said another way, what do you feel is your superpower as a venture capitalist?
It's a great question. So, I mean, what I say is I think I've done a really good job. There's like 22 people now at Struck Capital, and I think I've done a really good job surrounding myself with people that are smarter than me. And the way that I sort of meet the bar or meet the moment is I outwork them or I just push myself as hard as possible. But I think sort of checking your ego at the door and understanding where your strengths, where your weaknesses, and how can you surround yourself with just incredible 10Xers that can sort of complement you and maybe actually level you up in areas where there might be deficiencies. I think so for me, sort of hiring and bringing the right people around me has been a very robust superpower. I would say the other one is just sort of being able to deal with adversity and get back up. This whole game is very, very difficult. What is a tailwind one day is a headwind the next day. There's a ton of competition. It's moving very quickly. And I think sort of being comfortable, feeling comfortable while being uncomfortable is sort of a critical thing that I believe for me, I do better than most.
Now, when it comes to Struck, I think that the definition of pre-seed, seed, Series A, like they all over the last several years have started to blend together, or at least are much different than when I first got in the game, 10 plus years ago. And so just for those that don't know Struck, don't know the studio, don't know the capital fund, what exactly is the right sort of fit for you guys? What stage are they at? What sort of funding are they looking for? And maybe you could talk about the types of industries that are just like the best fit for you guys.
Yeah, for sure. So from a Struck Capital perspective, in terms of like our underwriting paradigm, everything we're doing is in the B2B software space.
Okay.
So we've been doing it for 12 years. We've had a lot of accolades. We've hit unicorns in every vintage. And a lot of that has been sort of vertical SaaS system of record platforms. Now, given the proliferation of AI, it has sort of evolved into what I would call vertical agentic platforms or system of action platforms. Every system of record platform now has to layer on agentic action-based workflows or else they're going to be eaten alive. And then vice versa, every AI native agentic platform starts off wanting to play very nicely with the system of record platforms. They want to read and write to everything. But if you fast forward enough in their product roadmap, they all want to become the system of record. So it's a very natural sort of evolution and extension of, sort of an underwriting thesis that we've had for over a decade now. But yeah, from my perspective, if you're in a multi-billion-dollar market, you've got a clear path to six-figure ACVs, you're building system of record or system of action, agentic workflows, no matter what the vertical is, we would want to talk to you.
I'm curious, it's pretty timely, the concept of, agents taking action. I think that this year has been full of AI, 2025 full of AI, but it feels like only in the last couple of weeks, there's this explosion around OpenClaw or ClaudeBot. And, for a consumer like myself, it's the first time of like, oh, the agent taking action. I'm curious, like, what's your perspective on what's happening? How do you envision it shaking up the startup world? And yeah, I'm just curious your perspective as someone that has probably seen a lot of these types of companies, but maybe not everyone knows about them.
Totally, yeah. So I think what's so incredible about agentic AI and sort of the proliferation of that is you can go to enterprises and say, hey, instead of me telling you to, adopt a new system of record platform that's going to come with switching costs and maybe turbocharge you a little bit, you can literally now say, hey, instead of me tapping into your software budget, I want to tap into your labor budget because I'm going to create a highly verticalized, accurate agentic system that's going to take a back office task that you were doing that was, costing you, countless hours and creating robust, sort of costs from a headcount perspective and maybe impacting your gross margin and EBITDA margins. And now all of a sudden, I can take what took you hours and it can be minutes or seconds. And because of that, I want to tap into labor budget because I'm actually going to get rid of headcount or I'm going to take the same amount of people and I'm going to 10x them. That's a whole other level of value that I had not seen previously in like a sort of vertical SaaS lens. So in that sense, it's extremely exciting. But we've been seeing for a while these sort of highly accurate agentic systems automate back-end manual tasks. And when you look at like a Claude bot or Moltbot now, I guess is what they're calling it, it's really about sort of repetitive tasks that it can sort of automate for you. It can reason for you. And, it wants to have access to a lot of a lot of your sort of databases. And there are potential security risks associated with that when people don't know what they're doing. But at the end of the day, right, if there is a highly manual, repetitive task, it's very plausible for there to be an agentic system that can automate all of that. And then when you build in things like the ability to reason, and then maybe when you build in things like persistent contextual awareness, like memory, it starts being really, really powerful. So yeah, we've seen it for some time now. I think with what's happening with Claudebot is it's really sort of becoming this like consumerized sort of, approach to that. And my advice is just do it carefully.
Yeah.
Carefully.
Well, you're looking at someone, I've got my Mac Mini that I just purchased, and, I myself spent the weekend playing with it, dabbling with it. And it was interesting to me how free flowing I was in giving it access. Now, whether or not this is going to be the worst decision I made, it's interesting because like in the, kind of early internet.com days, like people would be like, wait, we would give a credit card. What will happen if I give the credit card? Yet here I am giving it access to my email, access to my calendar. And so it is interesting how quickly not just the tech is, but the adoption and how willing people are to test. Knock on wood, this doesn't completely backfire. I told my agent, I said, don't fuck me.
Yeah.
Now you have backed so many early stage companies, and I'm curious, like in your mind, what is the most underrated quality that you've seen in your successful founders? So when you talk about the unicorns across the vintages, when you kind of like look at the founding teams, the execs, like the people that you've backed early, what were some of the underrated qualities or qualities that maybe aren't right at the top of mind, but you do believe really impacted the success of the team or the company?
Yeah. So I think everybody's going to pay attention to things like information asymmetries and like what was your prior experience and what school did you go to and have you started a company in the space and all of those things. But honestly, from my perspective, the way I would describe what makes an incredible founder, and I think if I surveyed all the portfolio companies that, we invested at seed and, sort of, hit escape velocity and started dominating markets, every single narrative is going to have a situation where the founder or the company like almost died, had to make a major pivot, lost product market fit, had to outflank a well-funded competitor. So from my perspective, what really matters more than anything, it's sort of a combination of horsepower. Like, do you have this unrelenting desire to push, operate with urgency, have that sort of like 996 mentality, coupled with the ability to literally go through an extreme amount of adversity and like wake up the next day and be excited to do it all over again. That to me, in a sense, it's hard to quantify what that attribute is, but I can guarantee the founders that are sort of comfortable with getting punched in the face and can get back up, and it doesn't decrease their horsepower. In fact, it gives them like a chip on their shoulder and increases their horsepower. Those, in my opinion, are the best founders. And I still feel like that is underrated. It's easy to quantify things like what school did you go to? What job did you work at? Where are you? What area are you an expert in? But like the actual ability to say, hey, if everything goes wrong, are you going to wake up the next day and still inspire your team and keep moving and keep pushing? And is it actually going to put you in a place where you push harder? Those are some of the skills that, in my opinion, have made incredible founders in our portfolio.
When you have multiple options of amazing talent, let's say, for example, the team is really promising, it's a product that's really nice and cool, and you could see the future, right size audience or right size market, but there's something in your gut that's kind of telling you, I'm going to pass on this one. What tends to be some of the red flags that are indicators that maybe founders don't even realize are coming off as a red flag? Yeah. So what are some of those traits that show up as red flags when it seems like most of the boxes are checked?
Yeah, it's a great question. The quote unquote like spidey sense is something that you want to rely on. For me, a big part of it would be like, I want confident founders, but founders that have so much hubris that they don't want to be coached, in my opinion, is really like a manifestation of deep-rooted insecurity, which makes it really hard to be a leader, especially in tough times. So sometimes we'll feel really good about a company from a diligence perspective, and then we'll go and meet the founder. And unfortunately, it isn't the right fit from like a sort of EQ or personality perspective. So things like that gut instinct and intuition is very critical.
Which is for you sometimes tied to something similar to coachability or willing to take feedback or adjust based on, taking in new information.
100%, because at the end of the day, even if a CEO is an absolute rock star, they need to be aware of their deficiencies. And in my opinion, the strongest CEO, the minute they raise that Series A, is going to say, hey, who could, like, if I can draft Michael Jordan right now, I'm going to do it. Even if they're objectively better than me, I'm going to do it anyway, because that, sort of is going to increase the enterprise value of the company, and that's the right situation. Whereas other founders that are like, hey, I'm concerned that this person could usurp my position, or they're just thinking about it incorrectly, that becomes very problematic. So we want founders that are very pragmatic, understand where they're incredible, where they, where they could either coach themselves up or where they're, they could hire, et cetera, to fill those gaps and deficiencies. The best founders are the ones that are inherently secure, and they just want the best people on the team, like no matter what that means for them.
When you think about the mistakes that founders make when pitching to investors, I think you mentioned the EQ side of, the coachability, the hubris, the, ability to take feedback and notes. I'm curious, are there any other common mistakes that founders make when pitching to investors? And I guess more from the perspective of like, how can they avoid them?
Yeah. I mean, like, just as an example, I usually want to invest in, if I'm investing in a team, ideally there aren't like duplicative skill sets. Like the ideal state is this one is like the go-to-market specialist and is going to sell and hunt. This one is the technologist. They're going to build an incredible product. So sometimes it's tough when you have two strong founders, but it weirdly feels like potential debt equity on the cap table because they're exactly the same. They're both CS majors. They're both highly technical, but like they're going to have to hire somebody to execute on founder-led sales because they just can't do it. That becomes a very tough situation, even if both of those people went to MIT and they're, objectively very strong candidates. Things like cap table optics are also like a great way to just, sort of put yourself in a position that you're sort of dead on arrival, no matter how strong the business is. Hey, there's an advisor that, has a bunch of equity on the cap table and they're not there day to day. Weird titles. Like, I don't necessarily want to see like a president at the seed stage or like a chief strategy officer at the seed stage. It kind of just creates more questions than answers. Like, what is that person responsible for? What are they doing? Maybe another one is like title inflation. Hey, this person is a strong engineer, but you've given them the title of CTO. They've never managed a team before. If you go raise a Series B from Sequoia, I assume there's going to be someone that would come in that would be stronger than them, but now there's no way for that person to get sort of the CTO position without going to the existing CTO and saying, hey, I need to change your title. Then maybe they're upset. They want to leave. That's more debt equity on the cap table. So yeah, unnecessary title inflation is a big problem as well.
That's interesting. I've never heard anyone mention that before, but it makes a lot of sense because, from a founder's perspective, you're like, oh, this is what they're going to want to hear. We have a chief strategy officer, but they don't necessarily realize that it's like, it's not the right place and time for it now. It almost comes off as a red flag, but they don't even realize it's a red flag.
Yeah.
Now, when a founder receives a no from a VC, which happens often and is probably I would imagine a tough part of the job is like, I want to invest, but it just doesn't match up or fit. What should a founder's immediate next step be when they receive a no? How should founders act when they don't receive the investment?
Yeah. Great question. So, listen, every single interaction with a founder is a data point, right? So like, yes, 99 out of 100 times, if you go to investment committee and the answer is no, it's going to be very hard during that specific process to all of a sudden get them to like reopen, sort of their investment decision and look at you again. However, right, especially if it's like for us, so we are typically early stage seed investors who like leading seed rounds, but we'll also write pre-seed checks. So there are times we'll say no to a founder at the pre-seed, but if they handled that correctly and appropriately, if they come back to us at the seed with a little bit more traction, we might be really excited to lean in because we were just impressed with how they sort of handled the totality of the process and specifically how they dealt with the adversity of us saying no. So what I would say is, as much as it's an emotional feeling, the worst thing you can do as a founder if you hear a no from a VC is respond in like an emotional manner.
Try to convince them of why they made a mistake in that decision.
Yeah, I mean, here's what I'll say. I think it's actually appropriate to say, hey, in a respectful manner, this is how we see the world, and I do want to give you a few rebuttals to the things that you were saying, but do it in a respectful manner, not in like a, I'm on tilt or super emotional. I like founders that if we tell them no, they want to push back within reason, because it shows me that the best founders are the ones that see a brick wall and they say, I'm either going to jump over it or I'm going to burst right through it, right? Like I want to see that. And at the end of the day, it might not be a fit for us, and maybe it's a fit for another fund that we do a lot of work with, and our investors on our team will share it, and then we'll say, hey, we said it didn't pass our IC, but I was actually really impressed with that answer. It's just another data point for you to prove that, hey, there's something special about me. So I don't mind founders pushing back. But you have to just do it. You can tell, right? If it's, hey, like, here are the mitigants and here's how I see the world, and I'm excited to keep you on my quarterly update list and update you in hopes of maybe partnering in the future, versus like, I'm emotional and I'm writing an emotional email, which is a bad idea.
Yeah, it reminds me of enterprise sales in that, if they just go, okay, no worries, it's like, okay, well, then they're not going to fight to get that big customer. But at the same time, if you're doing a sales pitch, you don't want to take it that one step further. Well, they'll never take another call from you again.
Totally. And I think it's important for founders to understand VCs get no all the time, right? When we raise funds and we go to LPs, you're hearing no a lot. And for someone like us that's building our own companies from the studio, I tell founders on the Struck Capital side all the time, like, one of the reasons why you should hopefully enjoy working with me is I'm also struggling for product market fit with the companies we're creating from the studio. I'm in your shoes. I know how that feels. So, in an ideal state, you can understand that, yes, maybe I'm hearing no today, but maybe there's a scenario tomorrow where I'm telling someone no, right? Whether it's an employee at my company, someone interviewing with me, etc. So I think the key is just don't get emotional. It can hurt, but that you should still keep your professionalism.
Do you or Struck have a specific evaluation framework or some kind of system where you've been able to start to codify how to invest in companies and what makes the right fit? Can you talk a little bit more about kind of what goes into an investment from a valuation perspective?
Yeah. I mean, so we are super productized, super quantitative. Every single deal that comes in, we actually score. We know who it came from. We know how it scored. We know how deep it went in the funnel. And there is a multi-pronged, multi-variable, large matrix of all the different things that we look at across product engineering, founder market fit, macro tailwinds, total addressable market. The list goes on and on and on. So yeah, we've really tried to productize that motion. But at the end of the day, there are aspects of it that that aren't necessarily quantitative, they're qualitative. And the critical component in that scenario is to hopefully be in a situation that all the investors on the team really understand the firm's lens, and they're viewing the capital that we're investing as their own capital. And they really understand how to assess those soft skills in a way that still feels productized. But yeah, we have a highly sort of multi-pronged approach to how we assess investments. And it is really cool to look back at the data, let's look back on last quarters or last years and actually see what happens. And we love presenting that to our LPs because it tells you a lot.
Now, when it comes to founders building their early team, you've had the blessing and opportunity to be both involved with your brother in building your first team. You now have the studio where you have, several new companies coming up. How do you advise some of your more junior founders where maybe they're elevating from a pre-seed to a seed stage, and now it's time to start building and bringing some teammates on? What advice do you have for founders when building their early team? Or what is a blind spot that you believe many founders undervalue or miss altogether in building an early team?
Yeah, totally. So listen, I think in the early days, you want a very strong technologist that's going to take the product vision of the CEO and actually create something and do it in such a way that there's not a ton of technical debt, and that if you can actually get an enterprise buyer persona across the line, that they stay and the retention is there because the product works. So building the right product is very critical. But the other aspect of it is really trying to productize the go-to-market motion. I want a CEO that can really execute on founder-led sales and is going to do the non-scalable things to just figure it out. And if that means like standing in the street and handing out pamphlets to people, like I don't care. Whatever you have to do to get qualified leads through the door, get sort of customer feedback so that you can actually look at your product roadmap and essentially embark upon, customer-driven development, which is the ideal state. Once you get to a point that you actually feel like, hey, there's some semblance of product market fit, the ideal state is you've actually productized and codified that go-to-market motion so that you can then start bringing in, SCRs and AEs to actually go and sort of scale what you're doing, right? But at the end of the day, the chef and the cookbook is created by the CEO. So when I see companies that like are hiring ahead of growth, like way too early, or bringing on like senior AEs or VP sales way too early, it makes me start to think like, what is the CEO doing and what is their role in the company? Ideal state from my perspective is a CEO is crushing the go-to-market motion. They are raising capital and they are hiring the right people. And then they're using what they're getting on the front lines from customers to influence the product vision. A CEO that can't sell and like very quickly wants to lean into like a VP sales, that kind of concerns me because you shouldn't be hiring those folks until you've established the playbook, productize the motion, and then you can sort of expand from there.
Now, a lot of modern day software companies that are pitching you, I would imagine have an opportunity either to go up market towards enterprise or go after more mid-market or SMB. I know this is case by case, for most of this, but when you have a company that comes in and they've got a rock solid product, you love the product, you see the vision, you understand what they're building, but they say, Adam, as of right now, we just launched this on Friday of last week out to the world here. So we don't have any customers, we don't have any revenue, but this is what it is. And you go, hey, I love it. You're still too early for me. Come back to me when you have some customers. What do you want from that founder? Do you want them to come back to you and say, hey, I did founder-led sales and I got my first enterprise deal, or I, came out with this cool go-to-market engine and we've got 20 companies that are like, what is the number and what should a founder, when they hear come back to us when you have some revenue, what exactly does that mean? And how would you recommend the right time to go back to that investor with the update would be?
Yeah, it's a great question. So there's many different ways to get revenue in the door, right? There's sort of like bottoms up PLG scenario where you're going after more of an SMB persona, but you don't have to be too concerned about unit economics because it's not like account-based marketing. There might be more churn, but if they can come through the door and convert without anybody touching them, that becomes really scalable and really exciting. On the flip side, it might be a scenario where your buyer persona and ICP is much more enterprise-esque, which in a sense, the sales cycles take longer. It's a lot more complicated motion, but the juice is worth the squeeze because you're getting 6-figure ACVs and there's an opportunity to expand into maybe 7-figure ACVs. So we're open to either approach. I think the critical component is just ensuring that, number one, it's unit economic positive. So what I would say is evaluate the velocity of the sales motion. How long does it take you to go from like a top of funnel qualified lead all the way to conversion? And then how does that compare to the actual ACV, how large the revenue opportunity is? So ideally, if it's like 100K ACV, you can show me that you can go from qualified lead to conversion in like 90 days. Like that would be like a gold standard. Obviously, if the ACVs are a lot smaller, that means the sales cycle needs to be a lot faster. So it's all about sort of, is it unit economic positive or not? And then secondarily, I would say really pay attention to quality of revenue, right? It's one thing like getting the revenue through the door, but if the customer has the ability to terminate for convenience, which means you're basically beholden to them consistently, they can tell you, I don't like the color of that button, it needs to be blue instead of green, and if you don't do it or prioritize it, I'm going to terminate. That's a big problem. So I think there are times where founders, want to ring the bell and get the revenue through the door, but they're sort of setting themselves up for a disastrous situation because they're not negotiating enough and the quality of revenue is not there. So those things are critical. Last thing I'll just say on that point is, especially in this AI native agentic world, we are seeing founders come to us with a ton of revenue, but they don't have an understanding of their fully loaded COGS, specifically their LLM costs. And sometimes to get a customer through the door, they're not capping the usage. So it'll be a situation where it's like, yeah, you have 120K ACV, but the customer's using it so much and you haven't capped it that like it's a 20% gross margin profile. Like on the one hand, sure, maybe we can fix that. But on the other hand, like that's a major quality of revenue problem. And that would put you in a place where you think you sort of scored a touchdown, but you really didn't.
Now, when it comes to being a VC, I'm curious, what is something that you believed about being an investor for way too long that ended up not being true or not being the way that you thought it would be?
Yeah. I definitely felt that like by being a seed stage investor and investing in, category defining companies, that like I would be there with them all the way through and like ring the bell at IPO. And that was just like a sort of an objective that was really important to me. I think what is manifested now with companies getting $500 billion or $1 trillion valuations, but still being private, and companies taking forever to go public, and having a fiduciary duty to your LPs to, sort of get them DPI and make it worth them investing. And also just fundamentally understanding that as a strong early stage investor, that doesn't mean you should be participating at the Series D led by a growth investor, which is just a different skill set. Really understanding that sometimes a really good deal could be one where you lead the seed round, you're with them for 5 or 6 years, and you take a lot of chips off the table at that Series C, and that's okay. I think the more naive investor in me when I first started this 12 years ago, there was an unrelenting, sense of wanting to be there the whole way through. And I think just given the way the market has manifested, that's not necessarily plausible or possible within the confines of a closed-ended fund with a limited term.
This might be a bit of a meatball layup question, but I'm just curious, like, is that driven, what you just mentioned about being with them through the end, is that driven through a financial lens of like, if I am with them all the way through, that will just be, it'll just be bigger? Or is it an emotional lens of like, we're fucking in this, we're in it together, I want to be there at the end of it?
No, it's definitely emotional. Because when we think about IRR and DPI, there are often times where a company raises a monster Series C and like with hindsight, like you should just take your chips off the table and get out. It might take them years to grow into that valuation. It might be a situation where they double revenue, but the revenue multiples shift because of the macro tailwinds become headwinds in the public market. And now you're in a bad place. So I definitely think from a purely financial perspective, there are incentives to take chips off the table earlier. It's the emotional perspective of like, hey, I'm ride or die with that founder and I want to be with them the whole way through. But I think that strong founders these days understand that, VCs are also, there's accountability to the LPs that give them capital to invest, and saying, hey, you just raised a great Series C and I led your seed round and I want to take some chips off the table. I think that's okay. Whereas maybe 10 years ago, founders wouldn't understand that.
When you think about managing LPs, this is, you talked about how you as a VC have to go out and get told no a lot. And I've talked about this at length on the podcast about how I don't think a lot of founders really understand the life of a VC when it comes to fundraising themselves, and that you guys, in many cases, have to talk to even more companies or more investors to get those LPs. Knowing that investing is on such a long timeline, what advice do you have for new GPs, new managing partners that are starting to take on more responsibility with managing the LP relationships? How can VCs navigate these long kind of investment cycles while still keeping the LPs up to date and wanting to invest in their next fund?
Yeah. So we definitely try and like productize the motion of like going really, really in depth during our quarterly updates, talking about all the portfolio companies, recording that, sending it out to LPs and non-LPs. I want the LPs to feel like they are literally with me in the room, when we are doing these quarterly updates, and that they really understand the good, the bad, the ugly about the portfolio companies, because in an ideal state, I can then benefit from their network, their primary and secondary connections, and they'll raise their hand and say, hey, I know somebody, let's add some value. So I think just the concept of like consistent productized communication with LPs is really critical. We've had a lot of LPs, institutional LPs, come to us and say, hey, I've been following your quarterly updates for like the last 5, 6, 7 years. I've been really impressed. And then all of a sudden it's the right situation and they want to invest in the newest vintage. So even if they're not talking to you, they're watching you. So I would continue to just show that body of work, even if you're not getting the reinforcement that you want today, because it might come later. It's naturally a long game. The other thing for us, I think that's been really valuable is our annual general meeting. We put a lot of resources into that AGM, and it's a great way for us to just get in front of the LPs, especially prospective LPs, and just show them everything that we're doing for us across the venture fund and the studio. So I think really just investing in that communication and understanding that it is a long road, and you should think of that relationship in the same way as you would with like a founder and expect 10 years plus is a healthy mindset.
Now, let's pretend that you have two post-MBA students. They're both working for Struck, and they both come into your office on their first day of orientation, and they say, Adam, we want to be successful and investors. We want to someday be like you. When you kind of are talking and giving this sort of advice to more younger up-and-coming investors, what do you think sets successful investors apart from non-successful investors?
Yeah, that's great. I think like what's really critical are the things that like I can't teach, right? Like I can probably teach you how to conduct diligence on a deal, what quantitative KPIs to look for. I can teach those things. What I can't teach is like proprietary access to deal flow, like incredible horsepower and work ethic, the ability to just, really create relationships with other VCs, other investors, and put yourself in a position that there's a really strong and robust quid pro quo, and you feel like, oh, hey, like for this great investor in Toronto, this great fund in Toronto, I'm their eyes and ears in LA, they're my eyes and ears in Toronto, and now I'm the one at the firm that controls and owns that relationship if we want to start sourcing deals from Toronto. So I think the ability for young investors to really flex like the EQ and the social network and develop proprietary access to deal flow is a really great way to rise through the ranks. The other one I would say too is just to really understand that even as a VC, if you're in the quote unquote power position with founders, every interaction matters. One of the things we pride ourselves on at Struck is like, if we go into deep diligence and we take your time, we end up passing, we're going to send a lengthy pass email that really explains to you what we were struggling with, how we arrived at the decision. And we're doing it because, number one, you don't want to sort of be an asshole. But number two, right, there's really a method to the madness there. We want to leave like a good taste in your mouth, even if unfortunately it didn't work, because maybe there's a chance where you come back in a subsequent round. Maybe you start a new company. Maybe you have a friend who starts a company. In my opinion, it's a golden rule, right? Treat people the way that you want to be treated. I think oftentimes sometimes young investors can take advantage of, like I'm the one making the decision, I'm in the power seat, and just because I don't want to do this deal anymore, I've had 10, back and forth cycles with you now, but now I'm going to ignore you and just like move on to the next thing. That to me would be a really, nasty thing. If there was someone at my firm that was acting that way, that would be very problematic. So I think just the concept of really leading with kindness and understanding that there's a person on the other end and caring about that long-term relationship is really critical, even if it doesn't serve you in the moment.
With so much growth over the last really decade, I mean, you've been building, growing Struck, you now have the studio. What is the part of your investor journey that you are personally the most proud of?
So, I mean, I'm obviously proud of like some of the wins. We were like a seed investor in Apollo.io.
We're a customer.
Okay, great. Yeah, we took the whole seed round of Zero Hash that was almost recently acquired by MasterCard for $2 billion. All of those are great. I'm very proud of the studio. We have a lot of quote unquote product market fit with Struck Capital. Things are going really well. One could argue we've made it harder to all of a sudden start building companies. But I think it's put me in a position that I can stand in a room and I just feel like I'm sharper than the other VCs that are deferring to advisors and operating partners and are reading about it, but they're not elbow deep in these emerging technologies. I'm in a constant state of just like pushing really, really hard because it is hard, right, to build companies, to invest in companies. But I'm really proud of being okay with sort of going against the grain and doing things that I think fundamentally will turn me not only into the strongest investor, but will put me in a place where I can serve my portfolio companies and founders in the best possible manner. And I think just given the current pace and velocity of core technology innovation, if you're not building, you just don't understand what's going on. So for me, I'm just really proud of sort of taking the plunge and saying, hey, instead of me abandoning, sort of how we like to underwrite deals and just doing deals at lofty valuations in 21, we slowed down and actually created the studio. We didn't realize that we were on the cusp of this like Cambrian explosion that is AI and that everything was going to change, but it's actually been like the best thing we've ever done because we literally have full-time PhD AI researchers on our team because we have a venture studio. It'd be really hard for me to diligence the next big verticalized agentic system if I didn't have those types of folks. And I would never have those folks if we didn't have the company creation vehicle. So I'm just proud of the ability to sort of like march to the beat of my own drum, so to speak, and do the things that I think will, put the firm in the best position, even if it's not like the vanilla way to do things.
How would you describe the current state of the funding ecosystem? Because when we last talked on the show, it was 2021. Probably couldn't have been a more frothy time, going into 22 and so on and so forth. Like, how would you describe the current state of the ecosystem? And if you would like, today happens to be an absolute bloodbath in crypto. I'm just curious if you have a perspective on it or like what the hell is going on, Adam?
Yeah. So here's what I'll say. I definitely think that like in a sense, there's some semblance of a hype cycle around AI. On the flip side, though, I think this is going to be the most wealth that has ever been created in the history of mankind. And when I think about what product market fit really feels like, the ability to go to like an insurance broker and say, hey, you were spending, you had a group of 10 people at your firm in your back office, each spending 5 hours a day doing policy comparisons. And hey, we built a highly accurate agentic system that can adjust those policies and compare them in 2 seconds. I've never seen core technology innovation influence and impact what we're doing in our daily lives like I'm seeing now. So I do think that there are funds out there that are, doing deals without maybe doing enough diligence, or they are abandoning their portfolio's construction theory around like does this entry point valuation make sense? But on the flip side, I believe what I'm seeing right now in agentic AI, tapping into labor budget instead of software budget, highly accurate action based systems, it's more product market fit than I've ever seen, and it's more powerful than I've ever seen. So that's sort of one side of the equation. On the crypto side of the equation, from my perspective, and I've been in and around crypto for a long time as well, the only things that I believe have any product market fit are Bitcoin as a digital store of value, and stablecoins as essentially an alternative to a fiat-based, sort of system where you're relying on a very legacy like wire transfer system. In my opinion, the promise of like true distributed autonomous organizations and Ethereum as a whole hasn't really manifested. And when I think about sort of what quote unquote product market fit felt like in crypto, and I compare that to what I'm seeing in agentic AI, it is night and day with like empirical data that I can actually show you. So in that sense, we're really excited to be investing in AI, and we're very open to it, especially because we're so early. Does that mean I would be, buying secondaries of OpenAI with a ton of fees attached to them at like a $500 billion valuation? Probably not. And does that also mean that there are times where we put term sheets on deals and funds come over on top of us, and do we think the deal should be at an 18 or a 14 and they do it at a 40? Like that does happen. But at the end of the day, I'm just seeing the ability to create value like I've never seen before. So in that sense, I feel like there's really robust and exciting product market fit.
What do you think are the biggest challenges that VCs are facing today, and how can they overcome them?
I mean, I still think there is a scenario where institutional LPs are overweight venture capital. They didn't have vintage diversification in 21. They invested in a ton of deals. Even though the IPO market has opened up a little bit, you have companies like Figma that are awesome companies down 80% since IPO. So I still think there's concern that like the IPO window is not really open, and that unfortunately cascades throughout the totality of the ecosystem, because if LPs are overweight venture capital, they don't have the dry powder to invest in managers, even if the managers are doing really well. So I think most VCs, if they're looking to raise relatively sizable funds and they're relying on institutional capital, it is still just a tough environment out there. Maybe another answer to this is like, is the VC's job in danger, and are they concerned about AI? From my perspective, I don't think the VC's job is in danger, but I do think that it's very critical to just pay attention to these emerging technologies and immerse yourself. And I'm not really sure how you do that unless you're building. And most of the VCs I speak to are not building. So I think a lot of them might really be struggling behind the scenes to like really understand, hey, it's my job to predict where enterprise value is going to flow, not today, but 10 years from now. But I don't even understand this core technology innovation. And I don't even understand what's commoditized and what's a defensible moat. I mean, literally, if you just look at the LLM battle, and we see this on a daily basis, GPT was king without a question. And now everybody is talking about Gemini, and like Anthropic is crushing with Claude. I'll just tell you, for us, with the agentic systems that we're building at the studio, and we've got a really exciting one called Memory, where we've literally created LLM agnostic persistent contextual awareness across interactions and product experiences. We have literally moved everything over from GPT to Gemini, because when we're extracting memories and creating semantic triples, it's just giving us much better results. My head of AI tells me that the reason for that is because Google has a larger corpus of data to train on than anybody else, and they're really, sort of, now that's all coming to fruition. But it's just a crazy situation, right? Like if you were like, hey, I'm investing in GPT because it's the king of the whole situation, and now all of a sudden, usage just dropped by 34% because people are moving over to Gemini. That's very scary. You have to really understand this stuff if you're going to underwrite it. And I just feel like there's a lot of VCs out there that they really don't understand it because they're not building with it. So
yeah, like, I mean, in the example, I feel like if you've never been really working with the LLMs, you could tell someone, you take all the policies, it'll review them all in 2 seconds, and you can kind of be like, oh, that's cool. But when you see it actually happening in real time, and you use it and you train it and you get better at it, you start thinking about, oh my gosh, this could impact this and this, and this could be done so, just so much better. When it comes to enterprise sales, I just read an article today about how these agentic systems are going to essentially represent like a seat in a software, where normally someone like Figma would sell 100 seats for the team. They're going to be represented by like one agent. And do you see enterprise sales changing? Like, how do you see these agentic workflow systems impacting some of your other investments that have traditionally been built around like selling lots of seats?
Yeah, totally. So we have one portfolio company called Rapid Flare that is trying to augment or inevitably replace sales engineers, specifically in electronics, semiconductors, so highly technical products with, thousands and thousands of SKUs, many different variables, very convoluted sales motions, and the ability to come in there and create a knowledge graph and literally automate things that would take your best sales engineer a week to come back with, because I'm AMD and they want to purchase something, but I've got 50,000 products, 50,000 SKUs. I've got distributors, I've got all these different permutations. It's very, very hard for a human to sort of have like the contextual awareness necessary to actually recommend the right product. And there's a huge opportunity for essentially agentic, highly accurate sales engineers that are vertically focused on that space to replace them. We are literally seeing that like with our portfolio companies. So I would definitely say that for companies that, and that goes back to like quality of revenue, right? Like the concept of selling per seat is problematic. There needs to be some sort of like usage-based component or performance-based component where the more ROI that the customer is getting from the product, the more you can charge, because you're totally right. You are going to be in a situation where one agent can have the contextual awareness of potentially 50 sales humans. So that would be problematic, right? You would have very material contraction if you were pricing per seat.
Yeah. Obviously it comes up in, when we have these sorts of conversations, it almost feels like there's, I don't want to say like two different, buckets, but there are those that are like, it's coming, we need to be on top of it and we need to know about it. And then there are those that are like, I don't know what it, but then it's going to take all the sales engineers' jobs, but then it's going to take this person's job. But then it's kind of like, it is both true and scary and also exciting. And I'm just curious, like, what do you think is actually going to happen? Like, yes, people are for sure going to end up with systems like this. You're going to have lots of people that move out of one industry into another. I'm curious, like, what do you think is going to happen, let's say 2, 4, 6 years from now, is like, it's more mature, it's more built out?
Yeah. I mean, I could definitely see a scenario where we need some semblance of like universal basic income.
Really?
Because a lot of people are out of jobs. I think, though, what's really important to understand is there are so many laborious manual tasks that humans have to do over and over and over again. And it's not really moving the needle. There are definitely opportunities to create agentic systems that can get rid of all of that, which in theory would allow humans to focus on higher level tasks. I still think it's going to be really critical for the AE to take the buyer persona out to dinner and have that relationship. But maybe when you're trying to generate the proposal, because the AI has a better understanding of all of the SKUs and can take all of the variables of the customer and match it appropriately, they're going to get that faster, right? Get to that faster. So I still think humans have a role to play. And I think we're going to be in a situation that things like EQ and connectivity and creating trust and relationships is going to be more critical than ever. In a sense, that's going to be the currency. There are others that say too that like at the end of the day, what a large language model is really doing is they're just predicting what should be, from a statistically significant perspective, what should be the next word, right? And it's all about sort of like the confidence interval. But at the end of the day, I think even if you look at something like Moltbot, when you see all of these agents talking to each other, if you stay in the conversation long enough, they start kind of repeating themselves because like the context gets recycled over and over again. I would hope that there's still a scenario where humans can come in and really, sort of come into the equation with opinions and innovation that's never been seen before, right? And then that can sort of proliferate that next version of, just sort of moving forward and taking things to the next level. So, I don't know how that works if we get to true like AGI. That's a whole other debate and can of worms. But like, I just think it's important to understand that while LLMs seem very intelligent, by definition, they're really just predicting like what the next word should be, and the corpus of data that they can draw upon is limited by the totality of the data, within that database. So it's human intuition that can really come in and maybe innovate and bring something new to the table, and then maybe AI that can turbocharge that.
Can you share a piece of advice or a piece of wisdom that you wish you had known earlier in your career?
Yeah, I mean, I think I started, I went to Georgetown Law and I was an M&A private equity attorney at Kirkland & Ellis. And I think I was trying to sort of please people around me, and I thought that like that was the definition of success. Go to a good law school, get a good job, and luckily for me, I kind of realized quickly that love K&E. They actually end up investing in Struck Capital, and I think they're some of the best lawyers in the world. But I just realized really quickly that I wasn't fulfilled by what I was doing, and I needed to try something else. There are others that I've seen make that jump, but they've locked themselves into a career for 10 years and then they've realized, gosh, I need to change something. I wish that when I was, first sort of starting out and going through school and all these things, because, I'm an immigrant, I didn't have, people that in my family that had said, oh, I've done this before. I wish I would have gone even faster in terms of just like pushing against the grain and seeing what sticks and not trying to like please others. I think luckily for me, I found out pretty quickly, and I only did 1 year at K&E before I left and started a company. But, it was a lot. I spent a lot of time, right, sort of going through, sort of college and graduate school, and it was still a lot of time. So I think people should really pay attention to what makes them excited and like what do they really want to do, and stop caring about what others think, because oftentimes the people that are trying to box you in are really doing it because
their own insecurity.
They have their own insecurities. Mm-hmm. Exactly.
When you think back to the early days of Struck Ventures, Struck Capital, what is the biggest change that you've seen yourself as an investor today?
Yeah, really good question. I think that, in the early days, there were fork in the road moments, and I was kind of guessing what I thought was right. And luckily, sometimes I was right, other times that was wrong. I feel like now, because I've had so many quote unquote reps and I'm building companies and investing in companies, I really do feel like there is again, a corpus of data that I can draw upon, where I feel like I'm really making the right decisions, and I can do that with a degree of confidence that I just didn't have previously. So I think for any entrepreneur, you're flying the plane while building it, you're faking it until you make it. It really takes adversity and sort of lots of repetition, and ups and downs to really be in a place where you're like, hey, I think I'm pretty good at this. I think I know what I'm doing. That doesn't mean you can't learn, you can't get better. But yeah, I just think the degree of confidence upon which we're making sort of critical decisions, it's much higher, because we just have a lot of experience to fall back on.
Yeah, I mean, one of the things that's been fun for me, as a fan of Struck from a distance, is watching you reinvent yourself, not necessarily pivot, but continuously evolve. And whether it was through Struck Capital, the crypto, the studio that you guys have been doing, I'm curious, what are some of the biggest mistakes that you've made as a venture capitalist, and how have you learned from them?
Yeah, I mean, maybe like early on in my career, wanting to invest in deals because I thought there were like hot, VCs on the cap table, or maybe having the spidey sense go off that there's a red flag here, but not listening to that and maybe still underwriting the deal. It's probably things like that. We're at a point now that we just have complete blinders on. Like, I don't care what everybody else is doing. There are so many examples I can draw upon where, like, we passed and then the founder raised from the hottest VCs in the world and then the company died. There are times where, alternatively, we pass and things went really well, and that's okay, right? I think the critical component is, don't be afraid to go against the grain, have blinders on, stick to, sort of the things that you think make you successful, and don't pay attention to the noise, because there's so much noise out there. I mean, if you go on LinkedIn, half of the stuff that you read, people just threw it into an LLM and then they're copying and pasting it and then they're like shouting from the rafters. I prefer to, really just sort of look at my own sort of empirical data and, make decisions that I believe are fundamentally in the best interest of the firm, even if maybe that's not like the hottest or sexiest thing, or it might feel counterintuitive today. I think that's okay. Have that confidence to go against the grain.
Is there any quote that really resonates with you that you try to live your life by?
Yeah. So I've definitely said this before, and it's a quote my brother gave me, which is, adversity is the stone upon which I sharpen my sword. I fundamentally believe you have to go through adversity to even enjoy what it feels like being at the top of the mountain. Every time I get told no, or every time I fail, it's just an opportunity for me to push harder, learn from it, and get better. And I try and instill that in my young daughters as well. It's okay to quote unquote like fall on your face, as long as you see that as an opportunity to get stronger. So, I tell the founders that I invest in, I want to know what's going wrong. I want to know what's keeping you up at night. I want to know what's the scariest part of the business, because that's how I can, number one, assist you. But number two, if you can't identify those things, then it's happening without your knowledge, which is 100 times worse. So I just think people have to be comfortable with adversity. That is how you not only get stronger, but that's why it tastes sweeter at the end.
You kind of mentioned it. I was going to ask about it anyway. I have a 5.5-year-old, you have 2 children, and I think both of us share the same philosophy around adversity and, the grit and what it took for us to get here and all the chips on our shoulder. But then we have our kids and we're just like, I don't want them to go through any pain, or I don't want them to feel that adversity. I'm curious, like, how have you tried to implement that in your own family? More asking for myself here,
yeah,
but if intuitively we know that's or part of the reason that got us to where we are, how can you, or how do you believe we can impart that into our kids?
Yeah, it's definitely tough. There's like I want to be a parent and I want to protect them from everything, and then there's I need to be a realist and I want to prepare them for how difficult the world is. So really sort of striking that balance. Mm-hmm. I think what I preach to my girls is if you just show up every day and you work hard, there's enough inherent talent in you that good things are going to happen. But it's really your decision, right? How hard do you want to work? When you experience adversity, are you going to keep going or are you going to quit? So we've really tried to instill in them from a very young age that good things don't just happen. It's really about, those who work the hardest and show, sort of bring that consistency. I think there's so many examples of great NBA players that sit there and say, listen, like when I was hooping, at the park back in the day, like I was not the best person on the court. I was one of the best, but I wasn't the best. But the reason why I'm here and he or she is not is because I outworked them, right? And my work ethic was the best. So from my perspective, it's about, what are the things that you can control? You can control like showing up to something with a good attitude. You can control consistency. You can control hard work, putting effort into something. So that's really what I try and prepare my girls for. I don't think there's any way that I can shelter them from adversity and pain. You just have to hope that the odds are in your favor, and if bad things happen, you can at least rebound from them. I think the hard part is when crazy things happen and it's just like, holy cow, and there's no way to recover. That's a tragedy. Anything else, in my opinion, is a learning opportunity.
What is one book that changed your life and why?
Oh, this is a hard one. I mean, I don't want to sound silly, but like I really enjoyed reading Ben Horowitz's Hard Things About Hard Things. That to me was, just to see what Andreessen Horowitz has done and to understand Ben's narrative specifically and how many times he was so close to failure and obviously rebounded. That was a book that I really, really enjoy. I also, for whatever reason, really enjoyed The Fountainhead by Ayn Rand, which basically pioneered objectivism. I did double major in philosophy at Northwestern, and I really enjoy reading books like that because it just allows me to question some of my assumptions and just give you another set of opinions that can maybe reframe the way you think about the world. So I definitely remember as a younger person being very impacted by The Fountainhead.
Adam, this has been an awesome podcast. As we kind of wrap up these last few questions here, if you could give one person a special shout out, anyone at all that has made a monumental impact on your life, who would it be and why?
Yeah, I guess I'll give a shout out to my partner, Mike Montero. Mike is a 4-time co-founder CTO. He was the co-founder and CTO of Resi, which I'm sure everybody has used to make a restaurant reservation. But before that, he started a company called CrowdTwist and sold it to Oracle. He also built the 11th largest site in the world. I think my relationship with Mike has been really incredible in the sense that we complement each other. And just given all that he's accomplished, it sort of puts me in a position that I constantly want to push and sort of rise to the occasion and sort of meet the moment. So I definitely appreciate, that relationship, which I think obviously started, very, business centric. Mike was a venture partner and operating partner at Struck back in 2019, and has now really sort of manifested not only into a partnership on the fund and venture studio side, but also an incredible friendship.
That's awesome, man. What are you most excited about in 2026?
I'm most excited about memory. I think 2025 was the year of intelligence. I think 2026 is the year of memory. We've built an incredible company from our studio called Memory Labs, memory with an I. So it's MEMORI labs.ai. And it is essentially an LLM agnostic version of memory, which not only from a user experience perspective creates this consistent contextual awareness across product experiences and conversations across LLMs. It also is incredible from a unit economic perspective because it's the best way to basically curtail a mounting inference spend, because why would I be submitting a duplicative query to an LM over and over again? There should essentially be essentially like a memory database where I can say, hey, this query is substantially similar to something that's been asked before, so I'm going to query that instead of experience latency and inference spend. So for me, I think 2026 is the year of memory. I think it's going to be the strongest thing that we need to really take LLMs and put them in a place that they can be used every single day. And we released our version of Memory Labs open source, and it became like a top 10 AI native repository on GitHub. It's in the top 0.01% of all GitHub repositories all time. And it's just super exciting. So yeah, I think that's going to be a big tailwind in 2026.
Let's go. Adam, where can people find you for those that want to learn more about the studio, want to talk to you, want to meet one of your partners or team? What's the best way to get in contact with you or with Struck?
Yeah. So struckcapital.com is our website, and more than happy for people to email me, adam@struckcapital.com. And yeah, we throw a lot of events around LA. We've got a great office in Santa Monica. We want to sort of be where founders are, and we want to have an open door policy. So if you're building something and you think it's exciting, come tell us about it.
Awesome, man. Well, Adam, thank you for coming back to Demo Day for your second episode. Super fun, high energy. Really appreciate you, man.
Thanks for having me. It was great.
Awesome. And for everyone watching at home, I'm Sean Goldfaden from Coefficient Labs, and this is Demo Day. Peace, guys.